With the S&P 500 trading at 23 times forward earnings, it's becoming harder and harder to find amazing quality companies trading at an undervalued price. But I do believe I have the best quality company that's trading at a very undervalued price relative to its fundamentals. And I recently listened to the earnings call. I own the company and I'm loving what the CEO said. And I'm starting to change my mind on the stock. I'm getting more bullish and I like what the company is doing. So I'm going to talk about this today, give you an update, give you my fair value and my upside potential. So I really hope you enjoy it as always. And the stock is Uber. Uber is down 7% over the last months. I've been talking about it from $78, $75 per share, and it's up a lot since then. But I still believe the stock is extremely undervalued relative to the fundamentals. I'm seeing $100 potential this year and 20% a year after 2025. So I believe the company has a lot of potential. Now, many of you might remember Uber as a cash burning company back in 2018, but this is no longer the case. Uber used to lose around $5 billion a year. Now they're making $8.5 billion a year in free cash flow. So it's a completely different story for a company like Uber, and free cash flow is ramping up. They announced a $20 billion buyback and they're going to buy back like 10% of the market cap. And it's a totally different company. It's not the Ubers that you used to know back in 2019, 2018. But in terms of earnings, they did meet earnings per share expectations of 63 cents. Revenue, it was a slight beat on revenue, nothing too crazy, but revenue growth was 18%, which was a reacceleration from the previous quarter. It was 14%. This quarter, it was 18%. So that's massive growth quarter on quarter. Adjusted EBITDA is massively ramping up. It was 35%. Same thing quarter on quarter, 4.5% EBITDA margin. This is pretty amazing from the company. Delivery is extremely strong, 20%. It's reaccelerating quarter on quarter in terms of gross booking, and EBITDA margin is now 4%. So it's massively ramping up. Uber is raising prices, the consumers are taking it, and they're still taking market share, they're still growing, and you could see the operating leverage that the company has, and it's just beautiful, where they're raising prices, they're increasing margins, while revenue growth is reaccelerating. It's not slowing down, it's reaccelerating. This is something that you don't find very often, and the stock is going down. To me, Uber is like the most misunderstood stories that I'm seeing in the market. Yes, the stock is up a little bit, but it should be up way much more. It should be up like 50-70% year to date. I mean, I just can't believe it sometimes when I look at those numbers, and then I look at the multiple, which I'm gonna show you the multiple. But if I look at the total monthly active platform customers, so the total monthly active users, 180 million people are using Uber every single month. 180 million people. Imagine the monetization potential of the app. 180 million people. In terms of the total trips every quarter, 3.2 billion trips were taken on the Uber platform in the second quarter of 2025. For gross booking, it was $46 billion. If you annualize it, this is around $160 billion flowing into the Uber platform. So imagine how much money they can monetize out of this $160 billion that's just flowing into the Uber ecosystem. And by the way, I'm using Fiscal.ai to come up with all those charts on a quarterly basis. No other company has those charts. So if you want to try it out, they give you 2 weeks of free access if you want to use my link down into the description. But for Uber, they believe the trend is going to continue. And they said at this point, we're not seeing weakness in the consumer. It's as steady as she goes. And for Uber, that's great news. So they believe the trend is going to continue. And this is pretty amazing from the company. Now, the main worry that everyone has around Uber is what are they going to do with autonomous vehicle? They do have a partnership with Waymo, with WeRide, and with many different partners, but they don't have a partnership with Tesla, and Tesla has been ramping up. And there's a lot of talks that Waymo could potentially break up from Uber, and it could potentially go on its own, or maybe they go through Google Maps, and Google Maps would create their own app, and then they don't even need Uber. So that's all possible. It's very possible. And I believe Uber is seeing this. It's seeing that potentially Waymo and other players could go on their own. And that's why Uber is trying to get direct control over a lot of the autonomous vehicles. And this is why very recently, I can pull it up, and Uber has announced pretty much a 6-year investment or a 6-year deal with Lucid, and they're going to invest 300 million in the company, and Uber will directly own 20,000 robo-taxis over the next 6 years, and Uber will directly own them. So they're going to directly control them, directly manage them. And this is a very different step from the company's traditional business model, which is being asset light. With them directly owning the vehicles, they're going to give them more control than just partnering with Waymo, and Waymo can walk away anytime. So that helps them, will give them more control. But that will also make Uber more of an asset-heavy business model, which could potentially shrink margins. And this is the main concern of the market. And it was my main concern as a shareholder. And that's why I was getting a little bit bearish on Uber. And I was questioning my thesis. I'm like, if they're going to keep buying autonomous vehicles, that's going to kill the margins. And Uber was not supposed to be a capital-heavy business model. It was supposed to be a capital-light business model. But after listening to the latest earnings call yesterday, I personally understood what the CEO is trying to do, and I believe it makes a lot of sense. And he explained it. And he said, I would tell you that there's 3 kinds of business models coming with autonomous vehicles. It's going to be what I would call the merchant model. And under the merchant model, we will essentially pay a partner of a certain dollars per trip per day or per dollar per day. And so the partner will have a kind of revenue that is very predictable, and we will take the risk of monetizing our network. So in the first business model with autonomous vehicle, the partner will own those autonomous vehicles. Uber will not own them, but Uber will pay them a certain fee for using the vehicles, and Uber will monetize them on network. So this is one way that Uber could potentially implement autonomous vehicles into their fleet. They can also control them, and they can also do it in an asset-light way. So this is the first model that's going to happen with autonomous vehicles. The second model that could happen with autonomous vehicles is the agency model. With the agency model, it's like a revenue share, which is, what they pretty much have right now, where drivers take a certain percentage and we take a certain percentage. So this is, again, where Uber doesn't own the vehicle. Maybe individuals or companies own those autonomous vehicles, and they would take a percentage of the profits, and Uber would take a percentage of the profits. And this is a second way where Uber would kind of have some control over those autonomous vehicles, and they would benefit from them, but they don't have to own those autonomous vehicles themselves. Now, the third business model with autonomous vehicles is where they actually own the vehicles, or where their financing partners might own the assets, and then they're essentially buying the cars, and there would be a licensing model and other things. So the partnership with Lucid is important, but this is not how every partnership will look like. Other partnerships might be where other companies will own the assets or the fleets, and Uber will kind of monetize them on their networks through long-term contracts where they pay them a fixed fee, and Uber will take the monetization risk, and they will collect the fees on the Uber platform. So it's not 100% asset-heavy business model with autonomous vehicles. This is just one way of doing it, but it's not the only way of doing it. So that personally gave me a lot more comfort as an Uber shareholder. And I believe the CEO is doing the right thing, because ultimately speaking, Waymo will eventually go on their own once they get too big, once they become well known, and Uber will be left behind. So with Uber doing this right now, it's going to give them a head start, and it's going to give them more control. And they said, we've obviously made the Lucid announcement, but we are talking with other major OEMs in the space, and we're confident that over the next couple of years, we will have OEM partners. And again, we bring a ton of demand. We got a great balance sheet that we can invest in order to prove out the financing of these models. We think we're in a great position to do so. So stay tuned. You'll see more announcement with OEMs. And then there are certain players like Baidu who also have established not just software platforms, but hardware platforms that look to be effective at scale and quite affordably, which is terrific. The Apollo Go is one example of that. So the partnership with Lucid is one partnership, but it's not going to be the only one. There are going to be more partnerships with more OEMs, with more auto manufacturers, and it could be potentially the same, or it could be one way where they can prove to other partners that this business model is profitable, that it actually works. And if they see that it works, then they will take the risk of owning the fleet, and Uber will collect the fees on that. So in this case, Uber will not directly have to own the vehicles, but what Uber is trying to do is they would try to just invest equity in the company and not actually invest money to own the vehicles. And this is what they said. They said, we think about our investment in AVs. You want to think about them in terms of where we will use capital to take equity positions in some of the software players or ecosystem players to help them kickstart their development. Where does Uber being part of their cap table sort of add to their credibility? So they mainly plan on investing capital into Lucid, capital into the other players. This is much more efficient for them, and not really just directly owning those autonomous vehicles. So the CEO said on the call, they plan to use 50% of their free cash flow to buy back stock, and the other 50% to invest into other autonomous vehicle opportunities. So now they're taking autonomous vehicles seriously. They want more control. They don't just want to depend on Waymo and being in hopes of someday working with Tesla. Tesla clearly does not want to work with them, and Waymo could potentially someday not work with them, and Uber will be left behind. So now they're kickstarting their journey, and they have the cash to do so. They have the balance sheet to do so. And I personally believe this is very smart from the company, and I really understand what they're doing right now. And that's why it made me a little bit more bullish on the company. And not all of it has to be asset heavy or capital heavy. Most of it could potentially be capital light, where Uber owns stake in those companies, just like Uber owns a stake in Joby Aviation. Uber owns stakes in Didi. Uber owns stakes in Grab. They can own stakes in those companies, and those companies will partner with them. And Uber doesn't directly have to own those vehicles all the time, but they are directly owning the Lucid vehicles for them to showcase that this model could be profitable. And once they show them that it's profitable, then other partners will be open for them to be buying the vehicles and for Uber to monetize whatever they purchase. So to me, it's very smart, and it really changed my thesis on the business. And Tesla will always be a leader, but it's not going to have 100% market share. And it's the same thing with Waymo. Now, in terms of the company, it's trading at 17 times cash flow, guys. 17 times cash flow for Uber. It's dirt cheap. I think it should be trading at 20 times at least, or 25 times. But 17 times cash flow is cheap for the company. And the growing free cash flow, 23%, 18%. Even this year is 20% growth. But here on FinChat or Fiscal.ai, it shows 1.7%. But last 12 months is 24. But it's actually 24% for 2025. It's 24% 2026. And I believe they will likely grow 20% a year for many years to come, as now operating leverage is kicking in. On a per share basis, it's even going to be better as the company is buying back stock, reducing shares outstanding. So at 17 times cash flow, we're getting Uber, amazing company, and they're growing much more than the multiple. So you're buying it less than 1 times the growth. To me, it's one of the best deals in the market. And I believe their strategy right now makes sense. And once the market believes that it makes sense and they see progress, the autonomous vehicle risk will get priced out of the stock, and Uber could potentially trade at the multiples that it deserves to trade at, which may be 20, 25 times earnings for a high margin tech company like Uber. And that's just my opinion on Uber. Hope you enjoyed it. Not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.